This is David Goldman, Asia Times Deputy Editor, speaking to you from New York City the evening of April 7th. China is tightening monetary policy. No question about it. If you look at the chart, you see that the effective cost of 7-day money to banks from the People's Bank of China, the benchmark 7-day repo rate, has been rising steadily. The daily fixing is now in the 3.5% range, as opposed to around 2.5% for most of 2020. And it's not only interest rates that the People's Bank of China is tightening. Chinese regulators are going after leverage in a number of different ways. They've ordered banks to restrict their lending for the remainder of this year, after a big burst at the beginning of the year. They've told banks to hold more capital against loans, and they're mopping up a lot of internet loan sharking masquerading as fintech, most recently, for example, loans to students at double-digit interest rates. Chinese regulators are also riding close herd on municipalities who've accumulated vast amounts of debt through so-called local government financing vehicles. China, in short, is fixing its roof while the sun is shining. The economic numbers are all looking very strong. The International Monetary Fund upgraded its forecast for Chinese growth this year to 8.4%. And the most recent Purchasing Manager indices show extremely rapid service industry growth. So China is earning enough to start paying off some of the enormous amount of debt that had accumulated starting with the 2008-2009 crisis. That's responsible behavior. It stands in contrast to the United States, which is still running up its credit cards and spending like a drunken sailor, running up a deficit equal to about 20% of gross domestic product. Now, paradoxically, in the short term, this puts a strong headwind in front of Chinese stocks. Equity markets love leverage. First of all, cheap money pushes investors out of bonds and other fixed income instruments into stocks. And secondly, it helps companies gear up their earnings and report higher earnings per share. Equity markets don't like monetary tightening. The United States equity market has benefited from monetary ease. The big question, which we addressed yesterday, is how far can this go? Goldman Sachs strategists say that the S&P has probably no more than about 5% of upside for the rest of this year, which is pretty meager compensation for picking up pennies on a volcano. The S&P has returned 9% year to date versus only 2% for the Shanghai Composite Index. For long-term investors looking for strong profitability based on sustainable long-term growth, Asian markets are well priced and attractive, particularly China and Japan. But if you're looking for a quick score in the stock market, Shanghai is probably the wrong place to look for it. This is David Goldman, Asia Times Deputy Editor, speaking to you from New York.